Thanks to everybody for joining today. We appreciate your attention. We know you have a lot of stuff going on as always. As Sabrina said, my name is Jimmy Williams. I'm with the Accelitas team. So just to start it off, we're in the absolute definition of uncertain times. I think everyone has seen, all you have to do is turn on the TV. Everyone's opinion is different on economic conditions, kind of where we are on things. And candidly, everybody's experience is different. So today's discussion is largely going to be lender focused. I think you'll hear that in a lot of the content. We know that there are lenders who are looking to both grow in this market, and they're navigating the volatility, and they're also managing existing portfolios, which can be a challenge as well, not necessarily always as consistent of a theme as it has been in the past. And what we hear every day is that lenders are looking for what's the actionable intelligence that's going to help them to identify those non-traditional creditworthy borrowers, help them make those informed decisions they need to make, and better manage the risk through that volatility. So what you'll hear today from the larger team is that we're going to try to give you both macro and micro insights. And the goal is also going to be to discuss some ways that you can leverage some of the unique aspects and unique sources of alternative data and the next generation analytics to fuel that growth. So with that, the learnings we hope that you take from today's meeting are one, how you can use unique sources of alternative data, how that can help provide a clearer picture, especially of those non-prime consumers, how to gain insights from transaction-based payment performance information, how that can lower risk and lending costs, how predictive analytics can help leverage alternative data, and how that can lower default and improve conversion rates, as well as whatever your performance metrics might be, and how custom models can be used to provide better performance. So we're going to tie all that together through the content of the couple different people that are involved in the webinar today, and give you some really specific actionable data to work with. And I already introduced myself a little bit, but just to be a little more formal, I'm Jimmy. I'm with the Accelitas team, and I lead the client-facing teams here. I'm based in Philadelphia, and the rest of our team is based throughout the country. James Cook is our head of product here at Accelitas. Say hi, James.
Yeah, hi, folks. Welcome. Glad to be here with you today. Head up the product management efforts here at Accelitas. Been doing it for a couple of 3 years now. I've led product management teams in several payments and data companies throughout my career. But look forward to the webinar today, and thanks again for joining.
Thanks, James. And a little bit about Accelitas, if you're not familiar with us. At our core, I'd say that we're a data analytics company. We use advanced machine learning and data science, combine that with labeled data to offer services in really 3 product families: screening leads, predicting credit outcomes, and validating bank accounts. Today, our clients range from lenders to financial institutions to fintechs, billers, all shapes and sizes. So a little bit of everything. And one of the key data providers and partners that we work with is Equifax, who we're very pleased to partner in this webinar today with. So thank you to the Equifax team. So at this point, I'll turn it over to the Equifax team to introduce themselves and get us going.
Terrific. Thank you, Jimmy. Hi, everyone. I'm Tom O'Neill. I'm a risk advisor at Equifax. And as a risk advisor, I'm responsible for helping clients manage risk, obviously, and achieve their objectives in light of economic and credit trends. And a fun fact, I like building contraptions like a room-sized flight simulator, complete with immersive field of vision. So that's just me. Bob?
Thanks, Tom. I am not that adventurous, except I guess I have done a couple of things in terms of outdoor stuff, like climbing Mount Rainier a couple times. But my name is Bob Hoffman, and I apologize for the background noise. The timing is always perfect with the dogs. But I have been with Equifax for about 18 years or so, and I currently now I am part of our specialty finance division. So I'll be addressing some of the alternative data that we have available for you to take advantage of in your models and your strategies.
Cool. Yeah, Bob, your dogs always have impeccable timing. So just a quick introduction of Equifax. I'm sure probably everyone on the call here knows us as one of the 3 national credit reporting agencies. But what many people may be unaware of is the broad reach of the data analytics and technology that we bring to the market that really go beyond just that traditional credit history. And a lot of that includes the kind of alternative credit data that will be central to our discussion here. But we won't go into depth in that. Instead, we'll just jump right into the challenges that we see many lenders dealing with today. And what I'd like to do is touch on the cause of those current challenges, which is the high level of uncertainty inherent in the market that we see today. We're not going to go into the causes of this uncertainty, things like the after effects of the pandemic economy and the Fed's actions to rein in inflation and so forth. Instead, we'll focus on the impacts of that uncertainty and what it leaves lenders trying to manage. And we're going to do that by looking, one, at the data, the credit trends. We'll look at things like rising debt and delinquencies. But then we'll also pull that into how that's created uncertainty at a more granular level, how households are impacted, by these economic conditions in different ways, and how consumers that are sitting on lender portfolios or in prospect databases right now may look similar from a traditional credit view of history, but may in fact be in very different financial situations. So with that, let's go ahead and jump into some of the initial trends, just so to set the table here. So starting with looking at overall utilization, we see that this illustrates one of those signs of uncertainty. Utilization rates on revolving credit has been increasing noticeably over the last year and a half. And that's even as overall credit limits, especially in bank cards and HELOCs, have also increased substantially. We've seen tremendous growth in originations of these products. So it's not just line increases, growing, but the actual originations, adding to this overall credit limit. And looking at bank cards specifically, while the utilization rate hasn't quite gotten back up to the 22% level that we saw in late 2019, it's approaching that threshold pretty quickly. And that current utilization rate, again, is on overall credit limits that are almost 15% higher than what they were, which means that the total card balances are greater than they were pre-pandemic. And while that card utilization increase has been growing across different risk tiers, across subprime, prime, super prime, and so forth, it's grown fastest in the subprime risk tier. In general, these may be the consumers most acutely impacted by inflation and other aspects of economic uncertainty, and they may be having to turn more to card spending to keep up with their ongoing expenses. Go on to the next one. And that's, I was going to say, it started to be reflected in rising delinquency, but it actually started over a year ago. For the last couple of years, we've been enjoying a period of historically low delinquencies. But that began to turn back upwards in 2021. And now we see that things like auto loan delinquencies have actually eclipsed their pre-pandemic levels, both in terms of delinquent dollars as well as delinquent units. And other trade types are still below the 2019 delinquency levels, but cards, in particular, are approaching those levels pretty quickly and could actually pass them shortly if the current trend continues. And even mortgage delinquencies, which are still extremely low, we're starting to see them start to tick up. So let's go on. And this is where some of that, what we're seeing on that macro level, is starting to come down to at a more granular level, at the level of making consumer level decisions. It would be one thing if we saw this growth in debt utilization and the increases in delinquency, happening evenly across the board, or even if we saw that happening consistently within different risk tiers or within specific population segments. But that's not the case. And this is where things are different than they were in previous times of economic stress, where even as things turned downwards, we could still more or less zero in on areas of impact and look to mitigate that risk in those areas. But But inflation, for example, which we really haven't had to deal with for decades, and even when we did deal with it, the last time was under much different societal conditions. This is an example of a current economic condition that impacts households differently, depending upon their particular circumstances. So, for example, while everyone feels inflation to some level, a family of 5 is hit with much higher grocery bills as food prices increase than an individual household. Employees working from home, don't like paying more for gas, but they're not having to absorb as much at the pump as people who need to commute to work. As a different type of example, individuals carrying student loans is an area where uncertainty creeps in, and not just around the student loans themselves, but on the impact of being able to pay, those non-student loan obligations, when things like deferment come off the books, or depending upon what the Supreme Court rules and so forth. And these are just a couple of examples where we used to be able to almost rely entirely on traditional credit history to understand who was likely to spend safely, who was able to pay off debt, and really who represented a good credit lending risk, as opposed to who was going to be at a higher risk of going delinquent. But nowadays, just having that traditional score and that traditional credit history doesn't tell us the full story. And I'll wrap up using this hypothetical example as something to illustrate this. Here we have 2 households. They probably have similar credit histories. They have they've generally been responsible in making payments. They don't have a history of overextending themselves. There may be some difference in the age of the accounts that they have on file, but overall, they both fall into prime credit risk territory, and they would appear to be good candidates for prospecting new credit products, or from an account management perspective, and that's reflected in their current credit score. But when we dig into this, all things are not equal here. The Smith household, for example, owns their home. They probably have a wonderfully low fixed rate that they've refinanced a couple of years ago, and they have very manageable, consistent payments on their house. The Jones household, however, rents, and they've seen those rental rates rise sharply. The Smith households, they feel the impact of inflation, but they have enough earning power that they can adjust to higher prices by making some relatively painless changes on their spending habits. The Jones household, however, they have a tighter budget, and they have fewer options when they're faced with rising food and costs on other essential products. There could be a number of other factors that go into this, but the point is that the credit score that we're seeing here is not telling the full story. Now, it's true that over time, we would anticipate the Jones score will probably go down as that financial stress forces them to maybe use more credit for essential purchases, maybe eventually have to start making tough payment prioritization choices, and maybe even start missing payments altogether. But that isn't what we see when we look at that credit score today. And what we see are 2 households that are sitting next to each other on our portfolio right now, and we see them as very similar, when one, in actuality, is a prime lending growth opportunity, while the other illustrates hidden risk. And that's why we need something more than just that traditional credit history. We need a more holistic view into the consumer's credit situation. And with that, I will turn it over to Jimmy to speak about how to go about beyond those traditional data sources. Jimmy?
Yeah, thanks, Tom and Bob. So, the 3 big challenges, and you highlighted a lot of these, one is that, things are changing quickly. We hear this from lenders. We've seen this through the pandemic. We see this now, that whether it's, existing models for new customers, or whether it's returning customers, that they're needing an additional look, and that whether that's score drift or performance drift, whatever it might be, that risk is absolutely something that's increasing, and there's need for strategy there. The traditional data sources, you touched on this a whole bunch. We saw this in a very big way over the last couple of years, that traditional bureau data just isn't enough alone. It doesn't stand on its own feet every time, and that deeper look that alternative data provides really does give that bigger picture to allow for tremendously more meaningful picture of exactly what's happening there with that consumer. And then the last is that, also that concept of scorecard fluctuation, being a little repetitive here, but again, things are changing very, very quickly. And so those models, those strategies can't be static. And real-time data gives you a lot of tools, but you have to maneuver and work with those tools. So now Sabrina is going to run a poll, and we just want to hear from you on the challenges you're experiencing as a lender. We'll give you a couple seconds. All right, Sabrina, what do we got? See what everybody has to say. And it looks like, for the most part, that it is that identifying credit-worthy borrowers that hits the high note here. Although there's certainly some performance-first ones, and then some, let's call it CX or UX of meeting the demands of digital-first acquisition. So that makes sense. Managing non-performance loans, a goose egg on that one. A little surprising there on that one, but good to hear nonetheless. So I guess the takeaway from this one is I love to hear that it seems like, at least based on the content of this meeting, that hopefully we're giving you some tools along those lines. So thanks for running that, Sabrina. So if we leave you with a call to action today, it really leans into these three topics. One is, if you're not already using an alternative data source, absolutely over the last decade, it is increased substantially, and it does provide that deeper look to make better decisions and give a more holistic feel of exactly what's going on. Custom models, especially in a dynamic environment, make a heck of a lot of sense. So that is a key tool. And then closed loop monitoring. It bears repeating all the time that without actually sitting down and looking at how things are performing and challenging it, and challenging not just your own model, but giving feedback to your data provider or to your data analytics company, whoever's actually doing part of that relationship, giving that feedback is incredibly important so that we can figure out, is there additional things need to be accomplished, models need update, has there been a significant change in the data, what's going on? So that model is very, very important thing, and that monitoring is extremely important. I'm going to turn it back over to Bob.
Okay. Yeah, thanks, Jimmy. Appreciate it. Okay, so this slide, what I wanted to talk to you about here is sort of tying back to what Jimmy was just talking about in terms of viewing alternative data or taking advantage of alternative data, but also kind of where it fits into what we're seeing going on in the market right now, particularly in light of the kinds of things that Tom was talking about, where financial stress, two households can look very much the same, unless you've got a way to really dive a little bit further into what's going on with that household beyond what you might see just in their core credit file. And so, if you think about alternative data, it has really kind of hit its stride over the past couple of years. And the thing about it, though, is that there are a number of different things that come to mind for people when they think about alternative data. So there's a lot of different data sources out there that sort of fall into this world of alternative data. In the case of what I'll discuss with you here, what we're talking about and what we're focusing on is Equifax's specialty finance data. And this is a database that Equifax manages, has over 80 million consumers in it. And you can think of this database very similar to how you would think of the standard credit reporting file, the ones that are managed by the three large credit bureaus. But the big difference here is that all of the credit data, so, the type of loan and the amount of the loan and payment history and all those kinds of things that you would think of in the standard credit file, all of that data that are managed in this credit file are for lending obligations that are not found in any of the major credit bureaus' core credit files. So these are loans that fall outside of the core credit data. So it's completely incremental data about consumers. So when we talk about that, so then you might say to yourself, okay, what kind of data are we talking about here? So basically, these are consumer loans that primarily revolve around short-term lending. That can be online or brick and mortar type of short-term lending stores. And then it's also the kind of rent to own, lease to own, auto finance, things like that. So as you can imagine, the value of the data is that it's giving you this insight into the borrowing behavior of consumers that's really not shown on that core credit file. And if you look at the pie chart on the right, what's kind of important about that is that the people that are in this database are not just people that are on the fringe. These are people that do use regular credit offerings as well and that are found on the core credit file. So in fact, about 70%, you can see in the dark gray piece of the pie, are consumers that are in the core credit file. Not only in the core credit file, they actually have thick files. So, usually like 3 or more trades. But then there's a whole other set of consumers in here. There's another 18% or so that are in the core credit file, but they have thin files. So they may be very difficult for you to evaluate effectively in terms of trying to find creditworthy consumers, like we saw in our poll. And then there's another 11% of consumers in here that are either not on the core credit file at all, or their files are so thin that they just don't have enough data to even be scorable. So what the data set provides to you then is this kind of insight into getting a more accurate understanding of how these consumers are managing these alternative financial obligations and how that could influence your lending decisions, both positive and negative. And what I mean by that is it's really important to think about these alternative credit data files as not just a negative type of thing. Right? In other words, a lot of times I think we used to think of these as, if they're in there, I don't want to deal with them. Right? I don't want to talk to them. In fact, you will find that there are many consumers in these databases that can manage these loans quite well, and they can give you insight into potential, not only just swap out, but swap in populations, more importantly, right? So giving you a finer scalpel to be able to dig in and see which are the ones that I really do have an opportunity to offer credit to that I might not have otherwise based on what I saw on the core credit file. And then lastly, what I wanted to mention to you on here, and this is, I think, often overlooked as well or not completely understood when we talk about alternative finance type of data sources. And this is the final bullet point on this slide, is that this data source that we manage, this is a CRA. So it is a fully FCRA regulated and compliant data source for use in your lending decisions. So this can be either, and you can use it across many parts of the life cycle. So it could be in the marketing side for pre-screen type of offers that you want to get out to the market. Originations, certainly. So at the time of decision, this data can be leveraged in a real-time fashion as part of your decisioning, and can be also used to find out what's going on in your existing book, kind of like what Tom was talking about. If you had both of those consumers on your existing book, it might be really good to know which one might be under more stress through in case they are, right? Leveraging additional types of lending opportunities that are not available on the core credit file. And how are they handling them? Are they doing well with them? Are they under further stress and they're struggling in that space as well? So there are a number of different things you can do with the data, but what I'm going to do now is sort of that idea of, okay, well, where do we go with this and what do we do next? So I'm going to hand it off to James, and he's going to talk to you a bit more about specifically how you can leverage these data sources in models and your own strategies, et cetera. So James?
Yeah, thanks, Bob. So again, at Accelitas, we really specialize in custom scores. So leveraging these alternative data sources, including the Equifax specialty finance data that Bob just described. And what our customers have found with these custom services is they can work in various places throughout their workflows. We're kind of showing a waterfall approach here, but various workflows where these scores can work, and also address various use cases that they have. They complement existing scores, or they could replace existing scores, so some flexibility there. But what the data scientists really like to do is to combine multiple data sources into one score, because sometimes 1 + 1 can be greater than 2, and so they can create an even stronger score if they're able to combine multiple data sources. And so our data analysts work with that type of approach as well. And just to echo what Bob had just mentioned, this is all still FCRA compliant and explainable services that our customers are able to use. If we go to the next slide, so we got a couple of things going on in this slide. The bottom right is a sample of a typical plot that the data scientists use to measure the effectiveness of a model or compare multiple models. You may have seen these before. As the line moves up and to the left, that model becomes more predictive, and the area under the curve, or the AUC, increases. This is the metric that the data scientists are looking for to see how well the models perform. And so to make this slide a little bit less of an eye exam, we set up the left chart here where we're comparing the AUC for 3 different generic models versus a custom model using 3 different strategies. So a blue strategy, an orange strategy, and a green strategy. And what you can see on this chart, kind of regardless of which strategy is chosen, the custom model on the right is strongly outperforming the generic models, about 15 to 40% improvement of the custom over the generic, depending upon which bars you're looking at there. So this was an actual modeling effort that we conducted with a prospect over the past couple of months, and really just demonstrates the potential of custom models. And so if we go to the next slide, another benefit of custom models is the ability to tune or retune these models with feedback data from what's actually going on in the market. And so this diagram here kind of depicts a feedback loop here of data being fed back into the modeling process in order to retune, improve the performance of the model. This is another area where our customers have benefited from this. They can leverage their own data performance and adapt their own custom models and kind of see what's changing in their specific marketplaces. So helping them to better address and kind of understand the uncertainties that their consumer set is displaying in the market. We've got a lot of tuning activity that's going on right now with our data scientists as folks are trying to relook at some of these models and figure out how to proceed moving forward. In a minute, we're going to see a little bit more specifics about this, but I believe Sabrina's got another polling question for us.
So the next polling question is up on the screen. I'll give you a couple of seconds to answer that. The question is, how often do you update your credit scoring models per year? So I'll give you all just a few more seconds to answer, and then we'll analyze some of the results.
Yeah, so, we work with our customers a lot on this, and, the challenges there of, them collecting the data and being able to provide it, as a feedback to us. For some organizations, it's a pretty straightforward and easy thing for them to do. They've put some good processes in place. Other organizations, it can be a little bit more of a struggle for them to kind of do that effort. So it'll be interesting to see what people have found in this webinar here.
Yeah, so James and Jimmy, it looks like we have a majority of people that have voted in the 1 to 2, 3 to 4 range.
Okay. Yeah, that would seem to make sense. We don't have folks who are doing it on a monthly basis. That's really too frequent a process, but every 3 months or every 4 months, that makes sense. So if we go to the next slide, here we're going to see some examples of performance improvements that we've seen here at Accelitas. This is 2 of our products throughout 2022. On the left-hand side, again, this is a favorite AUC graph we talked about earlier, showing the performance of the orange line over the blue line, if you will. This was an 18% improvement our data team was able to generate, leveraging feedback data for this product. I'm not certain how frequently the data came back. This is kind of a cumulative impact over 2020 year. over 2022 over the year. On the right-hand side, showing another product that had a series of 3 different improvements from performance feedback last year. The first one resulted in a 5% increase. The next 2 kind of bumped it up 1% each. And, you know, when you think an additional 1%, it doesn't really sound like a lot. I go through all this work in order to do this, but like in challenging times, every little bit of improvement helps. And, you know, everybody's looking to find growth wherever we can. So enough with the graphs, and I'll hand this back over to Jimmy to see if we can wrap this up and then get to some questions.
Yeah, thank you, James. So yeah, hope we give you a good oversight of some of the different capabilities that are there, and it's really what you see here, tying together all these pieces, the unique data sources, the analytics, the data science part of things, customizing the model, both tuned to your business, your customer, your use case, your metrics, doing that in an environment that is safe and secure, and then delivering based on the goals you're looking to achieve. So, you know, certainly next slide, Sabrina. You know, we would love to hear some questions, so we'll check here in a second, but certainly from myself and from the Accelitas team, as well as on behalf of the Equifax team, really enjoyed you guys taking part of it today. So thank you both as part of this. So Sabrina, let's see what questions we have in queue.
Yeah, so we have a couple questions that have come in, and please add any other questions you all have in the Q&A. We'll be sure to get to those, and I'll just kind of field this off to each of you, and whoever you feel is best to answer, go ahead and chime in. So we'll start off with this first question. What do you mean by real-time data?
Yeah, I'll take that one, James. You can jump in as the product lead.
Sure.
And by the way, if we don't get to your question, we're happy to follow up with you separately on that. But real-time data can mean a couple different things, but in the vein of this discussion, it's typically very fresh data reflective of the consumer's behavior at that point in time that is provided in a real-time environment, typically API. So, you know, I think as we saw during the first couple of months of the pandemic, and things were changing very, very quickly, traditional bureau data was reflective of an image from months or years prior. And as people changed their behavior day by day, that alternative data that gave real-time picture, a radar sweep of what was happening right then that day, based on payment transactions, based on behavior changes, you know, all of a sudden that really took over and kind of came into its own for performance-wise. So real-time data, again, arriving in real time via API, and then also reflective of actual consumer behavior that's happening right now.
Yeah, I agree with you on that, Jimmy. I'll second that. As I started getting more into this side of the business and some of the specialty finance side, one of the things that was really interesting for me in coming from, you know, many years in the core credit file side is that freshness of the data, the fact that, you know, the data is being updated every single day. And while there is reporting going into the bureau every single day as well, it's typically monthly, you know, 30-day snapshots that are coming in. Right. And this data in these data sets is as fresh, nearly as fresh as the day the customer has made the payment. Boom, it comes into the data set, or missed a payment, which is of course important as well when you're trying to decide who's the best person to be lending to in the moment. Right? So that part of it I found was really actually pretty cool. So like this kind of thing, like, you know, normally when you think of trended data and things like that, we often talk about that in terms of months, right? So we've got 24 months of trended data. When we talk about trended data in this world, you're talking about days, you know, so this is what happened over the last 1 day, 3 days, 7 days, you know, 15 days, things like that. So it is, you know, in terms of not just delivering it to you in the time of the decision, but actually the freshness of the data and knowing what just happened in terms of that consumer. That's pretty cool to be able to get that kind of connection to the performance that quickly.
Great, thank you both for chiming in on that. And next question is, are the decision models FCRA compliant and explainable?
Yeah, I think I touched on that piece earlier there. So all FCR data that's being utilized here and the models are all clearly explainable with appropriate reason codes and adverse action instruction, et cetera. So no issues there.
And then a follow-up to that, this is the last question that we have unless something else comes in, but how long does it take to implement those new models?
Well, most of the time it's part of it depends on how quickly we can get the data from the customer. The analysis itself, takes, a few weeks to take place, et cetera. So, you're talking about a handful of weeks in order to turn stuff around in order to get an updated model done. So pretty good turnaround. And again, when folks are typically only doing this, at the most 3 times a year or 4 times a year, that typically works well for their planning purposes, because they got to plan for stuff on their side too. If things are going to change somewhat in the model, they may have some downstream things that they need to address as well.
I have one more question that came in specifically for the Equifax team. You said that Equifax specialty data covers 80 million consumers. How does that compare to your competitors?
I can take that one, and without, I don't want to downplay my competitors, so I'll just keep with the facts. So with regard to a specialty finance data with 80 million consumers, that is the largest database in the industry.
Period.
Good answer. I think that
I would add to that. Taking the same approach Bob did, and it's less downplaying competitors as really reflective of the specialty data, alternative data area itself. It's growing across the board. Ours is the largest. 80 million is the largest database amongst the major carriers, but we're all growing. This is, and I think Jimmy made the point earlier. This is something that is no longer now it's no longer a point of interest type topic. It's now firmly established. We're in a period of time where specialty finance, alternative data, even in the name, alternative data is no longer so alternative anymore. It's becoming more incorporated into mainstream strategies and decision making, and that's reflected in our specialty data as well as others. Though we are still the biggest. So.
About to come up with a new name, Tom, for alternative.
Well, I think actually it did go from alt data to specialty. that's progress, right. I guess. But we've got to come up with something a little bit better than that.
As a follow-up to that, does the alternative data impact traditional scores? For example, like Vantage?
Yeah, that's a great question. I'm glad you asked that one. So the short answer to that is no. At this point, the data itself, given that it's housed completely outside of the core credit files, and Vantage score, FICO scores, things like that, they use the core credit data to calculate their results. So this specialty finance data does not feed into those scores currently.
Yeah, and I'll answer that from a slightly different perspective. Bob laid out how the specialty data is separate from the data used by Vantage and FICO to do those traditional scores. I'll answer it from a sort of decision-making standpoint, in that they're not competitive to those traditional scores. They are supplemental. They provide strength to that decision-making process. One of the things that sort of regretted about, what I was able to put into my kind of sort of displayed that traditional credit history and traditional scores, they're no good anymore. That's not the case. They are still good. They still separate the goods and bads well. They just don't tell the whole story that we need nowadays. And that's where bringing in this alternative data and the models and the ability to use that alternative data in the waterfall approaches and within your strategies, that's no longer just that's nice to do. It's now becoming more and more mandatory, to use these different views, the traditional and the non-traditional, in conjunction with each other.
Yeah, from an Accelitas perspective, I know we say this a lot, but I think that part of the attraction of our clients is the fact that the alternative data can be uncorrelated to the traditional bureau data, still predictive of credit outcomes. And and to your point, Tom, it really does provide that additional layer where one lets on, another one lets off, another one joins in and provides some more picture there. So whether it's whether it's a strategy to swap in or swap out, it's that next level that's there. And I can't remember, Tom, if it was you or if it was Bob, but the reality is that it's been probably a decade now, if not longer, that people started to really first experiment in this. So it's now there's a lot of different choices out there, and it comes down to in which use case for which target metric is which data source right. And then as James mentioned, in a lot of cases we're either fusing or working into a slot of, hey, it fits here next to this one well. So there doesn't have to be an either or. And in fact, I would agree vigorously with what you shared, that I think it's a lot more of, hey, here's how this one works and here's when it works.
Right.
Wonderful. Well, I think that wraps us up just at time. Again, very special thank you to James and Jimmy at the Accelitas team, and an even more special thank you to Bob and Tom at the Equifax team. Appreciate you all putting in the time for this webinar. And to everyone that's joined in today, we'll be sending out a follow-up email with a recording of this session, and feel free to send us back an email or reach out to any of our members for any questions that you may have that came out of this session. So thank you all once again.
Thank you very much.
Have a great day.
Thanks all.